China has been the major business story over the past few years, but with a slowdown hitting global markets in 2015, what will the future hold for the Asian giant? Patrick Chovanec, Chief Strategist at Silvercrest Asset Management, joins me down the line. Patrick, China's slowdown and stock market crash in 2015, what did you make of this, as people were quick to point to what they thought might be the end to the country's incredible growth story? But was it really just a necessary market correction?
Well, it was a necessary market correction, but it was also a sign of more serious problems within the Chinese economy. A lot of people who hadn't been paying attention to China were surprised by this. China has had mounting problems in terms of overinvestment, mounting bad debt, the drag that created on the economy, the need to make an adjustment to a different kind of growth model. And really, I think the big story of this year has been that the reforms that a lot of people were excited about and hopeful about really haven't come to fruition.
So moving forwards, what does China need to do to ensure the economy is on the right track?
China's actually laid out a lot of the things 2 years ago. In the third plenum, they came out with a list of 60 different reforms that would have been at least a good start to try to open up the economy, to try to make it more competitive, to try to encourage innovation, to try to improve the allocation of capital, because there's a lot of misallocation of capital in China just to try to boost GDP numbers instead of actually make the economy more productive. The problem is that while they've nibbled around the edges, they have not really been willing to engage in any kind of game-changing reforms, because they're afraid that this would lead to losers as well as winners, that this would actually make clear that there have been some losses that have taken place. And it's disruptive. And I think the other problem is that President Xi has prioritized very clearly politics over economics. And I think that there's a view that's prevalent in high circles in China that the economy can wait.
So what's the knock-on effect for the rest of the world of China doing this?
This is the interesting thing, because I think a lot of people look at China, its economy slowing, and they say, well, that growth is good anywhere, no matter what it consists of, and that slower growth in China, therefore, is bad for the rest of the world. I would very much disagree. A lot of the growth that we've seen in China has not been growth that's good for the rest of the world. It's been overinvestment. It's been adding to the glut of savings and the glut of supply that has been a deflationary pressure. And the end of China's investment boom is certainly bad for anyone who's been feeding into China's investment boom. It's bad for commodity prices, for instance. But it ultimately is exactly what the world economy needs. Less supply, more demand out of China. What people really need to think about when it comes to China is not supply and output growth, but rather consumption and demand out of China. And in fact, because China is a creditor nation and because it has run surpluses historically, it's actually in a position to prop up consumption.
So in terms of China's stock market now, and following the intervention in 2015, how are fund managers approaching this market moving forwards?
They're a lot more wary of China's capital markets and at least the onshore ones. It was back in June that actually there was a lot of talk that Chinese domestic stock market would be added to the benchmark global indices. The decision was made to postpone that, and I think it was proved to be a very wise decision. I think the very heavy-handed intervention by the Chinese government in the stock market, not just trying to prop up prices, but actually go after and punish people who sold or tried to sell, that will have a long-term damaging effect on the credibility of China's capital markets at a time when capital is leaving China, and they need all the more reason to attract capital into China to try to stabilize the economy. So I think it was very short-sighted, and I think it will have a negative impact on investors' perceptions.